Hi everyone, so welcome to the live broadcast, and I'm very much excited for having you today, being Friday, the last session for the week. So it's a business lecture in Woodin Show every day from Monday to Friday, 4 p.m. I go live on YouTube to teach on various subjects and various topics. And this week has been an interesting week. On Monday, we discussed a couple of issues. On Tuesday, we looked at financial reporting, IFRS 15, and those things. I think on Tuesday, we did an overview. Then on Tuesday, Wednesday, we looked at the FR. And then yesterday, which was Thursday, we started with a cost and profit statement in management accounting. So we looked at the part one, where we discussed the issue in relation to the various costs and how we prepare the cost card. But most importantly, we spent some time to look at the issue in relation to the overhead absorption. Okay, we spent some time to look at the issue in relation to overhead absorption. So today we want to look at the part two of that discussion in the preparation of the cost and profit statement. So this is part two, and we are going to be looking at how we can actually prepare a profit statement or a cost statement using the marginal costing, using the absorption costing, and using the activity-based costing. Now, for those of you who are located in places that you cannot attend lectures or something like that, but you still want to study and have access to my material, because some of you request a lot for our full videos, our full discussions in relation to that, which are not available on our YouTube channel here. You can enroll in the complete course online at the Nhyira Premium University.com/courses. That gives you access to the lecture videos, to the course materials, to our ebooks, catalogs, as well as a one-on-one session with a dedicated lecturer once a week to answer any questions on what you have studied for the week, so that you'll be able to prepare well for the examination. So in case this is something that you know you are interested in, something that you know is going to be assisting you a lot, which I know it will, because if you're a follower of my work and you've been watching my lectures on the YouTube channel, imagine having the complete lecture for financial reporting, having the complete package for man accounting, having the complete package for public sector accounting and finance. It's going to help you a lot so you can prepare well for your examination. So that is it for those of you who are interested in that. You can enroll in the course. The link is in the description, or you can call our office line or WhatsApp us 050-114-9296, 050-114-9296, and we will arrange your enrollment to be processed so that you can study for the ICAG May 2020 examination and beyond in relation to that. So if you are watching either the playback or the live session, you can comment below with any questions. Remember, this one-on-one YouTube sessions, I designed them based on questions that students would bring to us, questions that students ask us. So if there are any topics you want me to cover in whatever subject, as far as it's in the ICAG syllabus, then you just put it in the chat box, you put it in the comment box, because I'm going to be answering all of that for you. So put them in the comment box and I'll answer them for you. Remember to subscribe to the channel if you have not subscribed to the channel. Then share the video as well with your colleagues. Invite them to join the live broadcast, so together we can assist a lot of people. Every weekday from Monday to Friday, 4 p.m. I come live on the YouTube channel to teach and explain a lot of concepts. So share the video, give us a thumbs up, comment about it, share it on Facebook, on your WhatsApp platforms, and let's reach as much people as possible, because once you are finding value on my channel, it means that there are a lot of people that you know or who you know that will also be interested in the content that we are having here, and I know that we can together help as much people as possible. So let's get to the day's discussion. So we're looking at cost and profit statement part 2. The cost and profit statement part 2. So yesterday we looked at how we can prepare a cost sheet and how various overheads can be what? Absorbed. Now, when it comes to the preparation of the cost statement and by extension the profit statement, there are 3 schools of thoughts that can be used by the management accountants. Or there are 3 methods that the management accountants can use in the preparation of what? Profit statement. And we have what is called the absorption costing, then marginal costing, and then the activity-based costing. So these are the 3 methods or approaches that we use we will be using in the preparation of the profit statement in relation to how we allocate the overheads. So let's begin with the concept of the marginal costing. All right, let's begin with the marginal costing. Now remember that the marginal costing principle is fundamental and is critical. The reason why it is fundamental and critical is that it is a marginal costing principle that will be used when we get to the issue about short-term decisions. It's a marginal costing principle that will be used when we get to issues about even sometimes budgeting, because there are a lot of things under budgeting and variance analysis that the marginal costing concept is going to be there. So when we are preparing the profit statement using marginal costing, how do we go by that? So when it comes to the marginal costing, what we are interested in is first to determine contribution. All right, we determine contribution. So how do we determine contribution? Our contribution is simply going to be the selling price minus the variable cost. But this is where you've got to be careful. Contribution is the selling price minus variable cost. The variable cost we are bringing here includes both production variable cost, or if you want, factory variable cost, and then the non-production variable cost or variable overheads. So the first thing we are interested in what is contribution. Now, why are we doing that? Because in marginal costing, it is a system where variable costs are deducted from the selling price and all the fixed costs are what? Written off. In other words, when we are doing the cost statement or the profit statement using the marginal costing principle, all costs are divided into 2. Variable on one side and fixed on the other side. And the way that cost is divided will affect how we prepare our profit statement. So what are we interested in? The first thing, contribution. And that is your selling price minus variable cost. Remember, your variable cost includes what? The factory or production overheads and the non-production what? Overheads. Now, after we get our contribution, the next level is net profit. Net profit. So how do we get the net profit? The net profit is simply equal to the contribution minus all the fixed cost. Contribution minus fixed cost. So that is how we are going to get the net profit. Now remember, the fixed cost we are talking about here is both factory or production fixed cost and then what? The non-production fixed cost. Very, very important. So when we come to using the marginal costing principle to prepare the profit statement, we are just going to divide all the costs, all the overheads between what? Fixed overheads and then variable overheads. And all the fixed overheads will be written off against the contribution, and all the variable overheads will be deducted from the selling price to get our contribution. So if that is the concept and that is the principle, how would the pro forma of our profit statement be if we are using the marginal costing method to prepare the cost sheet or the profit statement? So profit statement, and we are using marginal costing. Profit statement, and we are using marginal costing. So I'm going to do 2 periods, okay? So let's do January and then February. Let's put our dollar sign up. So we will do first for the month, so the profit statement for the month. Now remember, the profit statement can be prepared quarterly, it can be prepared semi-annually, it can also be prepared annually, and even can be prepared what? Monthly. So whatever the examiner says we should do, that is what we're going to be doing. In my pro forma, I am going to be assuming that we are preparing the profit statement monthly. Are you getting it? Monthly. So what do we bring first? We bring our sales. Normally, the way we get our sales is by multiplying the units sold by what? The selling price per unit. We multiply the units sold by the selling price per unit. So under January, let's have 2 cash columns, and under February also 2 cash columns. So that the sales goes to the second column under January. Then we say less marginal or variable cost. Less marginal or variable cost. So what are the marginal or variable costs? Sometimes there could be an opening stock. If there is, we bring the value of the opening stock here. Normally at the first start, they may not be opening stock, but if there is opening stock in the question, boom, you've got to bring it. Second one, you bring the direct material cost. You bring the direct labor cost. Note that sometimes the the production cost will be given based on what? The production unit. So the examiner may give us the material cost per unit. So if we want the total material cost here, that means we will use the material cost per unit and multiply it by what? The total units that the company has produced. Very important, you should be able to distinguish between units produced in the calculation of the cost and units sold in the determination of what? The selling prices. Most of the time they are not the same because there is going to be valuation of closing stock coming in very soon. So you have to be able to do that to be able to distinguish that. Then we come to direct expenses, if there is any in the question. And the summation of all direct costs gives us what? Prime cost. Prime cost. So that is our prime cost. Now, once we get our prime cost, we say we add the variable factory overheads. We add variable factory overheads. Now remember, we are dealing with marginal costing. That is why we are bringing variable what? Factory overheads. So we add that. Then we'll get the production or the factory cost. The production or factory cost. Once we get a production or factory cost, we're going to be lessing closing stock. So we less closing stock. Now here, when it comes to the closing stock, you're going to be doing the workings for the closing stock. Are you getting it? You have to do a workings for the closing stock. So how do we go about that? So valuation of closing stock. So the valuation of closing stock is going to be simple. It's going to be unsold units, okay, divided by units produced times the factory cost or the production cost. The unsold units divided by units produced times the factory cost. Remember, the unsold units is the difference between your production and what? The units sold. So if you produce 10,000 units but you sold 9,025, that means you are left with what? 975. And so that 975 becomes what? The units sold. Okay, the units sold. Then we are going to have what? Divided by the units produced times the factory cost. So all the time you're going to be making doing the workings for the closing stock. Now once we get that, we deduct it. Then when we deduct that, the answer we get is a marginal or the variable cost. Marginal or the variable cost. Now we call it the factory marginal or production cost. Sorry, variable cost. So we deduct that from the sales figure, and that gives us what is called factory margin. Now, why is that important? Why is that important? That is important because you know that I told you when you subtract variable cost from sales, you are supposed to get contribution. But here we are subtracting the variable cost from the sales, but I'm putting factory margin here. The reason is that so far we've dealt with only factory issues. But remember I told you the variable cost includes both what? Factory cost and then non-production overheads, okay? Variable factory cost and then variable non-production cost. But now we've dealt with only variable production cost. For that reason, the answer we get here is called what? The factory margin. So after we get a factory margin, we say less the variable non-production overheads. Okay? Variable non-production overhead. Now the variable non-production overhead could be sales and distribution cost. So they could say that selling expenses is $5 per unit. So if they say selling expenses is $5 per unit, what do? We just use that to multiply what? The unit sold. Okay? We use that to multiply the unit sold, then we will get what? The selling price, the selling expenses. And that is a variable production overhead. So when we deduct that from the factory margin, then we can now get what? The contribution. Then we can now get the contribution. I hope you've got it so far. So that is the first part of our work. Now, if in the question there is no variable non-production overheads, then certainly the factory margin becomes what? The contribution. So in the question, if there is no variable non-production overheads, all we do is where the factory margin is, that will become what? Our contribution. So we said that the first stage is getting the contribution. So after you get the contribution, what do you do? After you get your contribution, what do you do? After getting the contribution, we look for net profit. To get net profit, you have to deduct fixed cost from what? The contribution. So we will say less fixed cost. And the fixed cost here will include both factory fixed cost and then the non-production fixed overheads. So the two will be deducted from the contribution. I'm just trying to put all of them here, and then we'll get our net profit or loss. If the answer is negative, that will give us what? A loss. So this is how we prepare the profit statement using the marginal costing approach. Make sure you understand how the principles are being used here. So we bring our sales figure, we bring our less marginal cost, we bring opening stock, we bring direct material, direct labor, direct expenses, get our prime cost. After that we add variable factory overheads. Variable factory overheads, then that gives us the factory cost. Once we get our factory cost, what do? We calculate the closing stock, and we need to do a workings for the closing stock, and that is going to be the unsold units divided by the units produced times the factory overheads. The unsold units divided by the units produced times the factory overheads. Once we have the the closing stock, we deduct it from the sales figure, and that gives us the factory margin. The factory margin. Then, if there is variable non-production overheads, like selling expenses, which is variable, then we will deduct it from the factory margin, then we will now get what? Contribution. Once we get our contribution, what do? We less all the fixed costs, factory fixed costs, and then non-production fixed costs, and then that gives us our net profit or loss. So if that is the information for January, all you must note is that the closing stock for January will become what? The opening stock for February. Are you getting it? The closing stock for January will become what? The opening stock for February. So that is how we prepare the profit statement using the marginal costing. Now, I'm going to leave it to be there. Then we will go to the absorption costing. Then we will look at how the absorption costing is also done. Then I want you to be able to spot what? The difference of bets. So let's see. So profit statement, this time around, we are going to be using absorption costing. So profit statement. This time around we are using absorption costing. Now, if we are preparing a profit statement using absorption costing, it's no big deal. It's no issue. Under absorption costing, one assumption we use is that overhead is absorbed using labor hours. Listen to this carefully. In absorption costing, one of the basic assumptions we use is that overhead is absorbed using labor hours. Sometimes the overheads can be absorbed using labor machine hours, but traditionally we say the overheads are absorbed using labor hours. So what do we do then? The profit statement using absorption costing is just like the profit statement you know from your financial accounting class or from your financial reporting class. Only that we're going to be adding a sweet spot to it to make it different in terms of the management accountant representation. So let's see how this is prepared under the absorption costing. Like I said, it looks like the normal profit you know from your financial accounting class or your financial reporting class, the profit statement. It's the same thing here. So the first thing we are interested in here is our gross profit. Are you getting it? Is our gross profit. And what is gross profit? Gross profit is sales minus cost of sales. So whilst you are dealing with sales minus marginal cost here to get contribution and the marginal costing, in absorption costing, you are looking for sales minus cost of sales to get what? Gross profit. That's the first thing. Now, after you get a gross profit, traditionally, you are supposed to less what? All other expenses to get net profit or loss. But where the sweet spot comes in for management accounting is where we are going to do what is called over and under absorption of what? Overheads. Over and under absorption of overheads. That is where the sweet spot also comes in. So let me stop talking and let's get into it. So January, February. January and February. So January and February. So two cash columns as always. So the same things happen. We're going to bring our sales because that's the first thing. So the same workings we did here, unit sold times selling price is the same thing. Sales will not change because we are using a different method. However, off the bat, you have to start spotting what? The differences. So what do? We say less cost of sales. Remember, in marginal costing, what were we lessing? Marginal cost or variable cost. But in absorption costing, you're going to be lessing your cost of sales. So let's get into it. First, we bring the opening stock. if there is any for the first period. We add the material cost, direct material cost. We bring our direct labor cost. We bring direct expenses if there is any in the question. We sum all that up and it gives us what? The prime cost. So the summation of all direct costs gives us what? Prime cost. So the same thing as prime cost here, it's here. But this is where the difference begins to come in. We will say add factory overheads. Now, under the add factory overheads, we're going to be bringing both the fixed factory cost and then the variable factory cost. So we bring the variable and we bring what? The fixed. This is where one of the differences comes in, and you should be able to spot that as soon as possible. If you realize under the marginal costing, add factory overheads, we only brought what? The variable factory overheads. But in absorption costing, what are we bringing? We are bringing both the variable and the fixed. Because all costs that we incur to the factory must be brought into the computation or determination of the total cost of the products. And so that gives us the factory or production cost. Now, once we get the factory or production cost, what do? We less opening stock. Sorry, closing stock. So less closing stock. Again, you're going to be doing the workings for the closing stock here. As always, you're going to be doing the workings for the closing stock. So how do you go about the workings for the closing stock? It's the same thing. It's unsold units divided by the units produced times what? Factory cost. But this is what I want you to understand. In the marginal costing approach, you are bringing only variable factory cost. Okay? In the marginal costing, the factory or production cost we had here was only including what? Variable factory cost. But in absorption costing, the factory or production cost we are bringing includes both fixed factory cost and what? Variable factory cost. And according to IAS 2, one of the distinctions about this two methods also is this, that according to IAS 2, inventories must be valued at what? Full factory cost. That is why the absorption costing is preferable over what? The marginal costing. So with marginal costing, you are valuing inventories at what? Only variable. There are fixed costs also that companies incur that we would have to what? Take notice of. But in the absorption costing, it considers that, and so this will be a full factory cost because it includes both the fixed components and what? The variable components. So when we make our computation there, calculate that, we less it from the sales figure, and what we get from lessing the closing stock from the factory cost is the cost of sales. Okay? But remember here, when we subtracted the closing stock from the factory cost, what did we get? Factory, marginal, or variable cost. We got factory, marginal, or variable cost. So once we get a cost of sales, we deduct that from the sales figure, and that gives us the gross profit we were after. So that is the first aspect of our presentation for the absorption costing. Now, so when you reach this stage, you take a deep breath. You have finished one aspect of the question or of our statement using absorption what? Costing. But this is the sweet spot. Anytime you are doing you are preparing the profit statement and you are using the absorption costing, when you immediately you get to the gross profit, you must quickly think about over absorption of overheads and what? Under absorption of overheads. This is more or less like when we were in high school, for those of you who did accounting in high school, financial accounting, when you are preparing the financial statements, after you get a gross profit, one of the things that you have to do there is the provision for bad debts. So that you will determine whether there is an increase in provision for bad debt or there is a reduction in the provision for bad debt. Where there is increase in the provision for bad debt, it will go to the expenses. But when there is a reduction in the bad debt, then it will be an income, so you add it to what? Gross profit. So all the time in high school, when you're preparing the profit or loss account, immediately you get to gross profit, you must go to the footnote and find out what is the closing provision for bad debt. You compare that to the opening. Has it increased? If it has, then the difference goes to expenses. But if it has reduced, then the difference is added to what? Gross profit. But when we come to the management accountant, after gross profit, he doesn't deal with provision for bad debt, but rather he deals with over or under absorption of overheads. But the question you need to ask yourself is, why is that important? Why should that be a subject matter that we look into or need to understand? Simple. Put it this way. The fixed overheads we are bringing here was based on, or is always based on, an overhead absorption rate we computed using budgeted information. Let me take that again. The fixed overheads that you will be bringing here is always an overhead absorption rate based on what? The budgeted information. However, you must find out the difference between the budget and then what? The actual results. That is why when you get to your gross profit, you need to compute and find out whether overheads have been over-absorbed or under-absorbed. So what do we mean when we say overheads are over-absorbed or overheads are under-absorbed? Let's look at that here. Now, to determine whether overheads are over-absorbed or under-absorbed, the simple test mark is that we compare the budgeted units against the actual units. Please listen to this carefully because this is very important. Many students are not able to get a full mark on these because of the over and under absorption concept. So make sure you get it well here. So what do? To determine whether overheads are over-absorbed or overheads are under-absorbed, what do? We compare the budgeted unit against the actual units. Number one, if the budgeted units are more than the actual units that we produce, then we say that overheads has been over-absorbed. Okay? Your budgeted unit you produced is less than the actual units. In that case, we say overheads has been over-absorbed. Scenario 2. If your budgeted unit is less than the actual unit, then we say overheads has been what? Under-absorbed. Now, so what is the meaning of this thing over or under absorption of overheads? Remember what I told you about the fixed overheads here. This fixed overheads you brought here was based on an overhead absorption rate. And if you remember what we did yesterday, overhead absorption rate is computed by looking at what? The budgeted overheads, okay, divided by the budgeted activity. Now, and I mentioned that usually under absorption costing, the overheads are absorbed using what? Labor hours. Now, the budgeted labor hours we're going to be bringing here is based on the budgeted units that we want to produce. For that reason, if we have to determine whether overheads are over-absorbed or under-absorbed, all we ask is we compare our what? Budgeted unit against our actual unit. So if we budgeted to produce 10,000 units, and based on that, we calculated an overhead absorption rate, but we realized that we actually produce only 5,000 units. That means we produce less than we budgeted. For that reason, we have charged more overheads than we are supposed to what? Charge. So when the budgeted units it's more than the actual unit, we say overheads is what? Over absorbed. But when the budgeted unit is less than the actual unit, we say overheads is what? Under absorbed. Now, when overheads when the overhead is over absorbed or under absorbed, how do we treat it on the face of the financial statement? Simple. So treatment. Over absorption of overheads means you've charged more than you are supposed to charge. Under absorption of overheads means you've charged less than what you are supposed to charge. Does it make sense? So over absorption means you've charged more than you are supposed to charge. Under absorption means you've charged less than you are supposed to charge. So how do we treat it? So when overheads are over absorbed, this is the treatment. Since it is over absorbed, you add it back to gross profit. Okay? You add the difference. The difference of the absorbed thing to the gross profit or expenses. If you are preparing the cost sheet, or you less it from expenses. So let me explain what we are saying here to you. So let's say your budgeted unit is 3,000, but your actual unit is 2,500. It means that once you compare it like this, budgeted is more than the actual, so overheads has been what? Over absorbed. So what is the difference? The difference is 500 units. So to get a figure for the over absorbed, we multiply that 500 units by the overhead absorption rate which we computed or which was given in the question. So when we multiply the overhead absorption rate with this difference, that is what gives us what? The over absorbed. And that is what we bring afterwards, the gross profit. Remember, in a single question, only one of these two scenarios will be there. Either the overheads are under absorbed or the overheads are what? Over absorbed. Very, very important. Then the second scenario is this. If overheads are under absorbed, meaning we've charged less than we are supposed to charge, for that reason, what do? We less it from our gross profit, if we are preparing the profit statement, or add to expenses, if you are preparing the cost sheet, or add to expenses if we are preparing the cost sheet. So that is what we mean by the treatment of the over absorption or over absorbed overheads and then what? The under absorbed overhead. So once we do these workings and identify and find out whether overheads are under absorbed or overhead are over absorbed, we bring that here. So over or under. So over will be added back to the gross profit, under will be subtracted from the gross profit. So you add or you subtract. Once you have dealt with the over or under absorption of overheads correctly, you less all your non-production overheads. Okay, so less expenses. So you less all non-production overheads, all of them, selling and distribution, administration, finance, whether they are fixed or variable, you less them here. And once you less them like that, you are going to get what? Your net profit or loss. If it's a negative, it gives us a loss. If it is a positive, you give us what? A profit. That is the issue in relation to that. So that is how we prepare the profit statement using what? The absorption costing. Now you got to make sure you get a difference between the two. You realize that? So what are the difference? Now, again, if we are doing for February, the closing stock for Jane becomes the opening stock for what? February. Okay? The closing stock for January becomes the opening stock for February. Now, so what are the differences between, how do we call it, the profit statement preparation using absorption costing and then using the marginal costing? Number one, in marginal costing, closing inventories are valued at what? Variable factory cost. However, In absorption costing, closing inventories are valued at full factory cost. You get the idea? So that is the difference there. In number 2, the first one implies that the second thing is that costs are distinguished between what? Fixed components and then variable. So in the marginal costing school of thought, it is not just about the factory, but it's about, is it a fixed, is it a variable? That is how we will decide where on the pro forma it has to be. But at the absorption costing, you realize that we are calculating or allocating the cost, both fixed and variable, to the production, and then the cost for factory non-production overheads are being written off because they are supposed to be written off. Another difference, which I've said earlier, is that according to IAS 2 inventory should be carried at full factory cost. For that reason, absorption costing is much preferable than what? Marginal costing, which calculates the closing inventory using what? The variable factory cost. So these are the things you need to understand about the absorption costing and then the marginal costing. So if you have any questions, you know what to do. You put them in the comment box, you put them in the chat box. If you are watching the replay of this discussion, you can put them in the comment box, and I'm going to be answering all of your questions for you in relation to that. Then if there are any topics also that you would want me to cover, any topics also that you want me to look into for you, you can ask me, and then we will be able to look into that for you. So that is the marginal costing, and that is the absorption costing. Now the next thing is the activity-based costing, right? The next thing is the activity-based costing. Now, how do we deal with the activity-based costing, and why did it even come up? Now, the activity-based costing will follow the same trend. The only issue has to do with what? How the overheads are absorbed. Remember, I told you that in absorption costing, we are going to be absorbing the overheads using what? The labor hours, or using the machine hours. But traditionally, we use the labor hours. Now, that labor hours which is used to calculate the overhead absorption rate is inappropriate because cost centers and cost units may use different labor hours. So if we are using labor hours to really allocate or apportion the overheads among the cost centers and cost units, that is inappropriate. That is why the third method was developed, and that is the activity-based costing. What is this about? With the activity-based costing, we classify all overheads into what is called the cost pool, and then we also identify what is called the cost drivers. So all overheads are classified or broken down into a cost pool. Then we also identify what is called the cost drivers. So what are the cost drivers? The cost drivers are the activities, the events that increases what? The cost. Alright? So under the activity-based costing, you are looking at the cost pool and you are looking at what? The cost drivers. So how is that going to be? For instance, example of the cost pool could be setup cost. Setup cost. Another example could be delivery cost. Another example could be machining cost. Another example could be machine running cost. So all these are cost pool. For each of these cost pool, we need to identify cost drivers. Are you getting the idea? So the machine setup cost, what is the cost driver that we'll be using for that? So for machine setup, we are going to be using the number of machine setup. So the number of machine setup that a product makes, that a cost center makes, will determine how much overhead they are going to be incurring, or how much cost they are going to be incurring. So the higher the setup, the higher the setup cost that you are going to be incurring. So you realize that under activity-based costing, what are we doing? We are and then what? The cost driver. Why is that important? Because in activity-based costing, we are going to be using the cost pool and the cost driver to calculate the overhead absorption rate. So we are going to be calculating the overhead absorption rate per a cost pool. Then we will now use that to absorb what? The various overheads. So the activity-based costing entails much work than what? The absorption costing. But the sweet thing in the activity-based costing is that you're not going to be thinking about any over or what under absorption of overheads. All you need to think about is, okay, this is a cost pool. What cost driver can I use to absorb that? This is a cost pool. What cost driver can I use to absorb that? So these are the things that you need to understand. Like I mentioned, under the activity-based costing, we are not going to be looking at what pro forma, how inventories, closing inventory should be calculated. No, we are just going to be looking at how various overheads are going to be absorbed by an organization, and that is what you must understand when we talk about activity-based costing. So these are the three things. So these are the three methods or approaches that are used by the management accountant in the determination of the cost of a product or a service. Are you getting it? In the determination of the cost of a product or a service. So if you have any questions about this, about the methods, now that we've gone through the concept, the next thing we have to do is to what? Solve questions. Are you getting it? The next thing we need to do is solve questions, because sometimes if the pro forma is given like this, you want to see the numbers and see how really the numbers will be adding up, will be subtracting up. But because of the time, we're going to be doing that on Monday, so you make sure you join the broadcast on Monday. If you're watching the replay, whatever day it is, just look for Monday, and Monday's date is going to be, today is 31st, right? So Monday's date is going to be, let's see, Monday will be 2nd or so, calendar, boom. Yeah, Monday is going to be 3rd. So whatever time you're watching this, you just have to look at the lecture video recorded on TED, and that is going to be part 3 of cost and profit statement on Monday, where since we've already explained the principles, I take a question, we solve the question using marginal costing, we solve the question using absorption costing, and we solve the question using the activity-based costing, so that you see how these three things are used to prepare various statements for the organization. So that is what you have to understand about these, and this is where I'm going to be concluding for today's broadcast. Thank you very much for joining the broadcast today. I'm very much excited. If you are watching the playback also, thank you very much for joining and watching the playback. I know that this is one of the critical topics that students face in management accounting, and so that is why I took my time to go through it to assist you in order for you to prepare well for your examination. If you have any questions, you know what to do. Put them in the comment box. But most importantly also, if you are thinking about doing the ICAG course online because of where you are located or you travel a lot, you can visit my website, NhyiraPremiumUniversity.com/courses, and enroll in one of the courses today and be part of our family, be part of our community. You get access to the lecture videos, full lecture videos, you get access to the ebooks, you get access to the question kits, you get access to a one-on-one session with me once a week via Skype, where I answer any questions that you are having, so I can assist you in order for you to prepare for your examination. So thank you very much. Have a safe and blessed weekend, and make sure you take care. Make some time to study. Because of the exams and the time that we have, we are already done with the 4 weeks. As at today that I'm shooting this video for the May 2020 examination, we've already done 4 weeks. So make sure you make time available. Make sure you spend some time on your own. Practice a lot of questions, because you can understand the principles, But if you don't solve questions, you will still be not doing well. But definitely in the exam hall, there is definitely going to be a question on this. It's a done deal. It's a done deal area that if you understand the topic well, you will be able to excel and answer a 10-mark question from there to be able to propel you to pass the examination. So thank you for joining the broadcast today. Love you so much from the team here at the Nhyira Premium organization. We send our greetings and note that we are doing this to enable you, to provide you with everything that you need, the resources you need in order for you to prepare for your examination. In February, we are going to be launching another key projects that we'll be noting about. So Monday, make sure you join me, and I'll be announcing that live on the broadcast, and it will help you to provide you the opportunity to reach us more on the personal level, so we can also reach you on the personal level. So you take care of yourself, and I'll see you on Monday 4 p.m. as we continue with our journey towards the ICAG May 2020 examination and beyond.